Welcome to vTalkInsight, Market Drivers Daily for March 5th, 2026. A deepening Middle East conflict is colliding with an energy supply shock, just as the AI boom powers ahead, creating an unusual mix of inflation risk, sector dispersion, and structural growth stories to navigate. Geopolitics around Iran and the Gulf have moved from background noise to a core macro driver, with energy at the center of the story. U.S. and Israeli forces have hit more than 2,000 targets across roughly 150 Iranian cities and now exert heavy control over Iranian airspace, while security risks and war risk premiums have brought tanker flows through the Strait of Hormuz down to a fraction of normal levels. Compared with yesterday, when attention focused on the initial Hormuz shock and the European gas spike, today's picture is one of a more entrenched disruption that is starting to rewire global energy flows rather than merely delay them. The supply-side stress is building on several fronts at once. Attacks on major Middle Eastern infrastructure, including Saudi Arabia's Ras Tanura refinery and a large Qatari liquefied natural gas facility, have forced precautionary shutdowns, while Iraq has already shut in more than 1 million barrels per day due to export bottlenecks. Qatar Energy has declared force majeure on some liquefied natural gas cargoes, and tanker owners remain extremely reluctant to transit the strait, even with military escorts and available insurance, keeping shipping activity near 5% of normal. Outside the Gulf, China has instructed its refiners to halt diesel and gasoline exports. Asian refiners are prioritizing domestic supply, and Japan is considering tapping strategic reserves, all of which point to tightening refined product markets and higher regional diesel and jet fuel prices relative to crude. This tightening is feeding directly into the inflation narrative. Brent crude is trading in the low to mid-80s and is up around 3%, while European natural gas prices have jumped about 7%, and gasoline and jet fuel are rising even faster, particularly for Europe and Asia. Estimates suggest that if oil and gas stay elevated for 3 months, Eurozone inflation could be pushed up by roughly 35 basis points, and a sustained $80 oil price could shave around 0.6% off global growth each year. At the same time, sustained triple-digit oil is flagged as a potential recession trigger for the U.S., where each $20 move higher could subtract about 1 percentage point from GDP growth, even though the country's status as a net energy producer makes this shock less severe than in past decades. Bond and currency markets are reacting more aggressively than equities. European sovereign yields, from German bonds to French and Italian debt, have moved higher since the conflict escalated, with bond markets now pricing a larger inflation and energy shock than local stock indices. Traders have shifted from expecting near-term rate cuts to modestly pricing in European central bank hikes, while in the U.S., higher oil and gasoline prices are helping to push 10-year Treasury yields up as investors question how quickly the Federal Reserve can ease. Traditional diversification has weakened because Treasuries are not acting as a classic safe haven. Yields are rising even as parts of global equities wobble, whereas gold and the dollar are absorbing more of the risk-off demand, and energy stocks are outperforming while travel, leisure, and small caps lag. The impact is highly uneven across regions. Europe and the UK, still heavily reliant on imported fossil fuels, face both higher inflation and weaker earnings, helping to explain recent equity underperformance versus the U.S. and renewed euro weakness. Emerging markets that import energy are seeing heightened currency volatility and sovereign outflows, particularly in the Middle East and Africa and in higher yield parts of Central and Eastern Europe, as rising oil prices and tighter global financial conditions collide. South Africa, for example, flags higher oil as an inflation and fiscal risk, while at a micro level, sectors such as travel and aviation are under pressure from surging jet fuel costs, even as more insulated names, like some Greek banks with conservative shipping loan-to-value ratios, appear better placed to absorb volatility unless the crisis becomes prolonged. Against this backdrop, it is striking how contained headline energy prices and risk assets still look. Brent remains below $85 and is described as moderate by historical standards, Inventories and strategic reserves still provide a buffer. India is resuming purchases of discounted Russian crude, and the U.S.'s energy independence reduces the risk of a 1970s-style shock. Some analysts even expect oil to drift back toward the mid-50s to 60s by year-end, and current Fed thinking frames the move as a modestly inflationary bump that should fade rather than a regime shift to stagflation. The tension for portfolios is that markets continue to price a relatively benign path, even as the probability of a longer-lasting disruption rises. Key watch points now include how long Hormuz remains effectively closed, whether attacks on infrastructure escalate further, and how quickly higher fuel costs show up in core inflation and central bank guidance. With that macro backdrop in mind, another structural force is shaping sector leadership and valuation spreads: the ongoing build-out of artificial intelligence. Despite the geopolitical noise, the AI trend remains a powerful, parallel story for markets, particularly in technology and capital spending. Broadcom has projected that its AI chip sales could exceed $100 billion by 2027, supported by an order backlog of around $73 billion, and that outlook has pushed its shares up by around 5 to 7% in early trading. European chipmakers are rallying in sympathy, and the broader message is that hardware beneficiaries of AI continue to enjoy strong demand visibility, even as investors debate how much of this growth is already reflected in valuations. Behind those numbers is a massive capital spending cycle led by the hyperscale cloud and AI platforms. Significant budgets from big technology firms are effectively creating a wealth transfer towards semiconductor manufacturers such as NVIDIA and Broadcom, and equipment makers linked to their supply chains. Broadcom's strategy of providing custom silicon, including specialized chips for major clients, positions it as a differentiated player in this race, while upcoming initial public offerings from AI names like Anthropic and OpenAI, alongside companies such as SpaceX, could expand public equity supply and redirect capital flows across sectors. Private markets are intertwined with this as well. Infrastructure and energy-related assets are seeing sustained interest as data center build-out and energy transition capex remain central themes, even as some private credit managers deliberately limit AI exposure to avoid concentration and hidden correlation risk. On the corporate side, early AI adoption is already influencing labor decisions and cost structures. Businesses report being able to operate more efficiently with existing staff, and major banks are increasingly using AI to manage expenses, aiming over time to reduce headcount growth or even cut roles as automation takes on more tasks. Layoffs explicitly linked to AI are now emerging across sectors beyond technology, and entry-level hiring is being scaled back in some industries, raising questions about future skills pipelines even as AI tools accelerate product development cycles and creative output. For earnings, this combination of productivity gains and restrained hiring points to potential margin support, but it also introduces longer-term social and political risks around employment that markets rarely price in fully. Regulatory and security considerations are another important strand of the AI narrative. U.S. government pressure on Anthropic to relax contractual limits on military and surveillance use of its models highlights a growing tension between AI firms and state agencies, while legal frameworks are struggling to keep pace with what mass data aggregation and advanced analytics can enable. At the same time, AI is raising cybersecurity risks for connected devices and informing military scenario planning, including simulations that reveal logistical vulnerabilities in potential great power conflicts. Physical security is in focus too, after recent drone strikes on Amazon data centers in the Gulf underscored that cloud and AI infrastructure in conflict zones face not only cyber threats but also kinetic risks, which could lift insurance and security costs and slow regional expansion. From a market structure perspective, AI is increasingly a common factor across public and private assets, which elevates the importance of crowding and valuation discipline. Software stocks are viewed by some as oversold after an extended derating driven by fears of AI disruption, Yet there is still high uncertainty about how individual company fundamentals will evolve, and at least one major bank has trimmed its Broadcom target on concerns over sector multiple compression and near-term guidance. Key watch points now are the next wave of AI earnings and CapEx guidance, the scale and timing of AI-related IPOs, regulatory moves on surveillance and defense applications, and whether AI-linked workforce reductions begin to show up more clearly in macro labor data. All of this sits alongside the Middle East conflict, which remains the dominant swing factor for near-term risk appetite and inflation expectations. The Middle East conflict itself has escalated in both intensity and geography, and that trajectory matters for how durable the current macro shock becomes. U.S. and Israeli forces have struck more than 2,000 sites across roughly 150 Iranian cities in just a few days, significantly degrading missile capabilities and effectively controlling large parts of Iranian airspace. The U.S. has also sunk an Iranian frigate near Sri Lanka, signaling that the confrontation is no longer confined to the Gulf. And the U.S. Defense Secretary now emphasizes that operations may last for weeks rather than days, challenging the market's assumption of a quick resolution. Political dynamics inside Iran add another layer of uncertainty. A succession crisis and power vacuum have produced erratic foreign policy decisions, including attacks on former mediators and neighboring states, even as Iran retains a significant stockpile of enriched uranium, enough for multiple nuclear devices. U.S. and Israeli objectives are not fully aligned, with Washington focused on limiting Iran's regional influence and avoiding large-scale ground deployments, while elements in Israel push for more fundamental regime change, leaving the conflict path harder to predict. Air campaigns face geographic and logistical constraints, making it unlikely that ground troops will be deployed, but there is open discussion of potential strikes on deeply buried nuclear facilities if hostilities continue, which would mark a further step up in escalation and regional risk. On the ground, the conflict is already delivering concrete disruptions to trade and infrastructure. The Strait of Hormuz has been effectively closed for nearly a week, with shipping traffic down more than 95% and many tankers unwilling to transit despite insurance and naval escorts, while efforts to establish escorted convoys face logistical and political hurdles. Attacks on oil tankers and facilities, renewed strikes on Saudi refineries, shutdowns in Iraq and Qatar, and force majeure declarations on liquefied natural gas exports are tightening supply chains and raising costs for oil and gas globally. In the air, more than 23,000 flights to Middle Eastern hubs have been canceled, removing over 10% of global aviation capacity, and airlines such as Emirates, Qatar Airways, and European low-cost carriers have suspended routes, with jet fuel prices outpacing crude and profit warnings emerging. Despite all this, much of the market response still looks like a wait-and-see posture. Equity volatility has been sharp at times, particularly in Asia and Europe, but U.S. indices remain close to recent highs, and there's been notable dip buying after initial sell-offs, echoing the pattern we saw yesterday when investors framed the shock as disruptive but short-lived. Institutional allocations to broad asset classes have barely shifted, and current guidance for many wealth clients is to maintain existing positioning, while traders focus more on near-term risk premia and options hedging than on fundamental de-risking. Under the surface, however, emerging market currencies and oil-importing countries are showing significant swings. Sovereign bonds in regions such as the Middle East, Africa, and high-yield Europe are seeing outflows, and European bond markets are pricing more inflation and energy risk than local equity markets. Policy and politics could amplify or mitigate these market risks. European policymakers are stressing a meeting-by-meeting, data-driven approach as they weigh the twin threats of higher inflation and weaker growth, and U.S. Federal Reserve officials note that the duration of the conflict will heavily influence how quickly they can move from restrictive policy toward rate cuts. Domestically, rising gasoline prices ahead of the summer driving season are seen as a potential political risk factor, with some analysis suggesting that high pump prices linked to the conflict could influence voter sentiment in the upcoming elections. At the same time, there are mitigating factors. Greece is still expected to grow faster than the Eurozone average despite the shock. Diversified multinationals, such as Merck and Campari, highlight that region-for-region supply chains and local production can limit direct operational disruption, and European banks' direct exposure to Iran remains small even as they run reverse stress tests for more extreme scenarios. From here, the central question is whether the conflict remains a contained but persistent air and naval campaign, or drifts toward a broader regional confrontation and longer-lasting disruption of energy flows. Key markers to watch include how long shipping and aviation restrictions around the Gulf persist, whether attacks move closer to nuclear facilities or to additional choke points, any sign that Iran's internal succession dynamics stabilize, and whether oil prices begin to test triple digits. A move toward those more adverse scenarios could force a rapid repricing across oil, inflation expectations, rates, and equities, particularly in Europe, Asia, and energy-importing emerging markets, whereas a stabilization without further escalation would support the current pattern of markets looking through geopolitical shocks. Taken together with the global energy picture and the AI growth story, this leaves portfolios facing a complex mix of short-term geopolitical risk and longer-term structural change that will remain in focus over the coming weeks. To wrap up, the effective closure of the Strait of Hormuz and wider attacks on regional infrastructure have turned the Middle East into a live energy and inflation shock, with bond markets now pricing more risk than many equity indices. At the same time, the AI buildout continues to channel capital towards semiconductors and digital infrastructure, driving powerful sector and factor moves, but also concentrating risk and raising new regulatory and security questions. Markets are still largely treating the conflict as a finite event, so the duration of hostilities, the path of oil prices, and evolving central bank guidance will be critical signals for cross-asset pricing in the days ahead. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.